Good afternoon, everyone, and welcome to the Daily Volatility Box Report for January 15th, 2020. We are TOSindicators.com, home of the Volatility Box. We have a lot to cover in today's video. We had quite a volatile day, and we'll go through each of our futures charts. So we'll cover the S&P, the Nasdaq, the Dow, and the Russell, and then we'll also touch on a couple other charts like gold, and then crude oil, which had inventories reports. We had trades set up in the Nasdaq, the Russell, and then gold and crude. So we'll talk about each of those trades, and then we'll also briefly discuss a trade in Goldman Sachs for those of you that trade only stocks. All right, so let's start with the S&P chart. So if we maximize the sell, we'll just go straight down the line. We start by evaluating that first hour test that we have for the volatility box to determine which levels we should be using, our conservative or our aggressive model. In this case, we saw that we not only breached our aggressive volatility box line, but we even exceeded what would have been the clouds before we got an opposite and reverse move. And that was our first sign to switch on over to the conservative box in the S&P futures. So once we load up our conservative volatility box, if we zoom out, we had no entries for the rest of the day. Now we'll switch on over to the Nasdaq futures and repeat the same exact process. Now something that you should notice with the Nasdaq is if we draw that same first hour line, in the case of the Nasdaq, we did not breach that aggressive volatility box entry line. And that was our first clue right off the bat that the Nasdaq was less volatile than at least the S&P, and we'll compare it to the Dow next to see how it stacked up. But really, the Nasdaq was the only indice that gave us the ability to use the aggressive volatility box for the rest of the day. So now for the rest of the day, we continued looking for opportunities in the Nasdaq for any breaches of this blue volatility box line. Our first breach came right here. However, this was at the end of an hour, so not really a valid entry for us as it's just got the least amount of edge when you're looking for a move that should be made over the course of an hour that actually starts to take place at the edge of an hour, right? The edge there is drastically reduced. So we're continuing to look for opportunities. And that first trade comes in the Nasdaq as price action falls in the final hour of the markets perfectly into our volatility box line. Our orders are parked right here at the entry line. Yesterday, that was a stop out for us, but in today's case, that let us actually participate in the trade. Our first target was 16 points, which is what we risked here. And that target was hit right here. And then our second target was at the target line, which was 25 points away, both of which were hit before the market actually closed, giving us a really nice winner. So this one trade on the Nasdaq was good for a positive $820 using the full size contracts. And if you're using the micros, then you can use the appropriate points. The first trade was a positive 16 points, and the second trade was a positive 25 points with a break-even stop. Let's keep going down the line to the Dow. Now, similar to the S&P, the Dow also breached our aggressive volatility box clouds in that first hour test, right? And this is that clear sign that we know now that the S&P and the Dow are much more volatile than the Nasdaq. And if we are looking to be a bit more aggressive, the Nasdaq is a place to be aggressive. But in the case of the Dow, we are forced to use our conservative volatility box, which even using that volatility box, we see that we still breached what would have been our clouds, given an entry, while not valid since it's that first hour, still gives us free information, which tells us that, hey, the Dow is really the most volatile, and if there's a market to avoid trading altogether, that's the Dow, as we aren't respecting even our conservative volatility box. So we'll skip the Dow, we'll move on to the Russell now. Now, if we come back to the Russell, we'll switch back to our aggressive volatility box. And we take a look, we'll see once again a similar pattern, right? The Russell also exhibited greater volatility than usual, and we breached the clouds, the aggressive clouds, in that first hour, giving us a signal that, hey, we should switch on over to our conservative volatility box. So now, once we switch over to that, we can see that the volatility here is contained a little bit better, right? We're actually getting a reaction in the opposite move from where our fade is. And this is our first sign that, hey, we can start to look at the conservative volatility box models on the Russell for any potential trades. Now, as price action continues, we're drifting in between the volatility box for most of the day. But when that Nasdaq entry comes in the final sell-off, the Russell also presented an entry. And the Russell had a really nice reaction move up. Once again, our orders are parked. That first target was 3 points, which is also equal to our stop. And that was hit almost right away. And then our second target was 6.5 points away at the actual target line, giving us both of our winners. So a positive 3 and a positive 6.5, with which our full-size contracts was a gain of positive $475 for the day with our 2-lot. And this is using our conservative volatility box, which is really the highest probability trades that we have that can offer us, even greater than the aggressive volatility box. Now let's keep moving down to gold. In the case of the gold futures, we were on our aggressive volatility box. Using that first hour test here, we see that we breached the aggressive volatility box line, but we also had that opposite and equal reaction, giving us the okay that it was okay to use the aggressive volatility box for the rest of the day. We had our opportunity in the gold futures as the price penetrated our volatility box. And in the case of the gold futures, we're still then waiting for our edge signals check, right? This is that second and third checkpoint after we've breached what is a more aggressive futures market than our indices. Once we get this edge signal check, that is our okay green light to continue to look at this as a valid trade. And we're looking for any entry better than our cyan line. So as price action falls right back into our normal entry point, this is where we get our orders filled. And our first target is 3 points, which is what our risk is. That target gets hit as we make the slow grind move up higher. And then we continue to go on and hit our second target as well, which was 5 points away at the target line, right? If we zoom out, we can see that price action for gold continued to rise from what would have been our entry, giving you what is almost your best opportunity to participate in the gold futures on your first pullback opportunity. That's where our volatility box entry lines really captured this move almost perfectly to a T. And in the case of gold, this first contract was a positive 3 points, and the second contract was a positive 5 points, giving us a total P&L of positive $800 with our two full-size contracts. And once again, in the case of gold, we also support the micro gold futures for those of you that are looking to trade the micros. Right, you'll see this is a very similar setup on the micro gold futures as well, using our aggressive volatility box. And then finally, we'll take a look at crude. And so if we move down the line into our charts, today with crude, we had inventories reports come out. And for our inventory report trades, we've talked about this in our trade plan. We start looking 4 a.m. onwards to see what volatility looks like. In this case, we were respecting our aggressive volatility box. That was our okay to continue to use the aggressive volatility box to try and play any fades off of the inventories reports. So as the report came out, we had an opportunity to get long as price action fell perfectly into our volatility box entry line. Our stop was outside of the volatility box where we had given it 30 cents of room. And that same 30 cents is what we were looking for our first target, right? Which was hit pretty soon thereafter. We did have this slight little heat check pullback, but really nothing to worry about as price action continued to hit what would have been our first target. And then our second target was at the target line, which is 58 cents away, which was also hit with our stop at break even at this point, playing with house money. So in the case of crude, off of the volatility of the inventories reports, we had one nice trade over our two contracts, the first of which was a positive 30 cents, and then the second was a positive 58 cents for a grand total of $880 per two lot. And then finally, we'll wrap this video up by talking about an earnings trade in Goldman Sachs. We've been talking about XLF as a theme over the course of this week's video, and one of the companies that were reporting earnings today was Goldman Sachs. And with earnings plays, we're looking at using our conservative stock volatility box. Now, in the case of Goldman Sachs, after its earnings, it gapped down lower, and then we were looking for this to fill its gap, which it did. However, our actual entry where we have an edge comes as price action breaches this first zone, which is our volatility box edge, right? This is the first area of opportunity that we can start to look at a fade. And for us, this is really the point of entry. It's the beginning of the clouds with the stop outside of the clouds, and our first target being this gray dashed line. We had our entry come as price action hit our volatility box clouds. In the case of Goldman Sachs, the reason why you may not be wishing to wait for this edge signal is because it is off of an earnings play where it's filled its gap, which it has a tendency of doing, per our Monday video, I believe, in which we talked about that using our smarter earnings tool. And the second reason is it also has liquid options, allowing you to play this move with puts that are fairly inexpensive for Goldman Sachs that are expiring in just a couple days. Right? In this case, we're really just looking for that burst of volatility, especially as we've gapped down lower, but price action is moving up. You would expect these puts to be slightly cheaper, and then price action gives you this nice little fall, which is about $1.50 in the actual Goldman Sachs stock. And for those of you that don't mind shorting the actual stock, this was another one that's a liquid stock that you had the opportunity to do. However, it is a fairly expensive stock, so that's where using options and leverage in the case of shorting ends up becoming a little bit more powerful. We see that not only did we get that same follow through to our first target, but we had a nicer follow through down in Goldman Sachs, where by the end of the day, the actual move for anyone who held all of their contracts was about 1.58% or almost $4 in Goldman Sachs, which is a pretty nice move from the option standpoint. All right, hopefully today's video helped you understand not only how to trade some of these more volatile events in the markets, but how to pick which markets you'd like to focus on and how to deploy your skills with whichever asset class you like to trade, whether it's futures, whether it's micro futures, whether it's stock, or whether it's options. All right, take care everyone, and we'll see you in the next update.